How does today feel compared to last March when the same thing was happening? Every day the market was down 10%.
Well, this is what's important to remember.
We made a joke. It was like it could only go down 10% so many days in a row.
March 31st, you guys have to remember that March 31st of 2020, the headlines all over the press, and you can go to the Wayback Machine and look at these things, but the Dow was down 20 some odd percent. The S&P was down 20%. And it looked like the world was going to end. And then we had our first big stimulus bill. And things started to China started to reopen slowly and things started to look better. And what's interesting is you have this rotational sort of deleveraging that's happening right now. People are repricing in inflation. People are moving into sort of these, overlooked stories, getting out of growth a little bit. And it's a bloodbath. But I would just encourage us all to remember that we were in some pretty dark days in March of last year as well. And, when you looked at it by the end of the year, it looked amazing. So
I would just add to that. The markets are looking pretty grim for tech stocks right now, but this all started because of a really great jobs report showing that the economy is roaring back. So we added 379,000 jobs in February, which beat expectations by 200,000. They also revised the January gains up 166,000. So now the unemployment rate is down to 6.2%. Remember, it was at like 15%, last summer during the lockdowns for COVID. So, all of this is fundamentally due to, I think, really great news in the economy because COVID is ending. And which kind of begs the question of why we need another $1.9 trillion stimulus bill. But I think that ultimately there's a lot of good news in the real economy. And what investors are doing is figuring out how to now price or reprice all these different stocks in light of the economy roaring back.
So just a little math lesson to build on what you're saying. Everybody has a risk-free rate. And all stocks are priced according to that risk-free rate. And when, for the last sort of year, particularly when risk-free rates were essentially zero to negative, meaning, that's the riskless money that you get from the government. It was hard to do anything except be long growth stocks in a big, big way. But David, to your point, if we get 2 or 3 more quarters of these kinds of jobs numbers, you're going to have a, low single digit unemployment number. And what that means is wages will have to go up for businesses to compete. And that's the kind of traditional form of inflation that actually reprices things because you lever up rates to kind of control inflation. When you lever up rates and all of a sudden they're not zero, but they're 2, 3, 4, 5, 6%. This is sort of what brought the tech bubble to a halt in 2000, which is that, you had 6% real rates. And so you can't own businesses that are projecting revenues, let alone profits in 2026.
When you can invest your money in a bond and make 6%.
6%.
And that's what I like. So just for folks that don't know, this week started with this big bond sell-off. And what that means is bonds that used to yield 0%, when you sell them, they're now yielding 10-year treasuries, I think, are at 1.5 points, right? And so as an investor, if I can make 1.5% with no risk by owning US treasuries over the next 10 years, that may feel like a better bet than owning some risky asset, some speculative company. Now, the other thing that it has done, and Chamath, correct me if I'm off on this, but what I'm hearing is that higher rate, because bonds sold down, because people are expecting inflation to come back up, the interest rates to borrow money are going up. And so if you're a hedge fund or an institutional money manager, over the last year or so, you've been able to borrow money for 0%. You can lever up your portfolio and buy as many stocks as you want without paying any interest on it. And now that rates are creeping back up, people are de-levering. They're taking risk off. And that's causing a sell-off in both bonds and stocks, and especially on the speculative end of the market where, there's been obviously unchecked kind of investment capital.
No, you're absolutely right. Like, look, at the end of the day, the cost of borrowing for a company goes up. What that's really saying is the investor that's lending them the money, has other alternatives, and so then they're willing to charge you more and more for this capital. And as that happens, you'll see some companies get into potentially some real trouble because, they're going to be borrowing money at rates where they can't necessarily generate the cash flows in the future to pay those things back. At the same time, as you said, if you look at sort of like, the SPAC market has taken a real beating. What are SPACs really? Well, in many ways, SPACs are synthetic bonds, right? And the reason is because, if you go and buy a SPAC, one share of any SPAC, you have the ability to redeem that if you don't like the deal that it does and get back your coupon. So, your notional rather. So if you were to buy a government, German bond at -1%, or buy any SPAC where you can put that same, $10 to work and get back $10, well, you do that versus getting back $9.90. So in many ways, the SPAC market benefited from rates at zero because you could synthetically be long SPACs as almost a way of being synthetically long fixed income. Now, as rates go up, that's not true. So what that leaves in the SPAC market are actually people who want to own long-term equity. And if you combine that with what we just said, which is the cost of capital going up and the discount rate going up, now all of a sudden companies need to be really real. And you're seeing that because if you look at the companies that have just announced SPAC deals just in the last few days, their stocks have gotten absolutely obliterated. And they're right on the knife's edge going into the redemption period. So if you have 1 or 2 more months of this where all of a sudden bonds look better and, some of these SPACs post-announcement but pre-de-SPACing go through, $10 a share, people will just redeem for $10. And you'll have a bunch of busted IPOs or mergers.
By the way, another thing we're seeing, sorry, Jason, but another thing I think we're seeing right now is in the near term is a feedback loop. So as selling takes place, what happens is market participants are jumping in and short selling and participating in the trend of that stock. And so there are these kind of experiences that are underway where it's not just about a sell-off of owners, but it's also about a momentum trade that a lot of people are playing into. And so there is a very short-term, extremely compounded effect of the delevering that's happening and the cycling that's happening in these markets. And so it's super volatile and probably will be for a little bit of time here, right?
I think so. I think we need to figure out whether there's really, whether there's a real inflation
risk
dragon cooking someplace. If there really is inflation, again, you have to think the trillions of dollars we put into the economy eventually has to come out in productive goods and services. And all of that excess capital will probably inflate prices. Now, it begs a different question, which is we've just actually been missing inflation all along, because if you ask somebody who lives in a city, what the cost of rent has been, that thing has been inflating by feels like 20% a year for years. So,
and healthcare and education costs.
And healthcare and education costs. So maybe we've just done a really terrible job in the last few years of actually measuring inflation the way it should be. It's calling this whole basket of, CPI X energy. It's kind of nutty. Maybe the whole thing just made no sense.
If you look at those 3 categories, what do they have in common? Education, healthcare, and housing, massive regulation. And then if you look at the things that have gone down, consumer goods, electronics, food, et cetera, or have stayed flat in terms of inflation, those are things that the free market participates in.
The government's not involved.
And it's not just the fact there's a lot of government regulation in things like healthcare and education. It's also that the government pays for a significant portion of it. And so there's no reason for the people, who are billing the government to keep costs down. This is why the price of education, of a college degree, keeps going up, is because the government's paying for a lot of it.
The only place in the market since 2010 where you would have made more money than being long Facebook and Google and Apple and Amazon was being long United Healthcare, Cigna, Wellspring. And the reason is because healthcare was this incredible thing post-Obamacare. Nobody wants to talk about it on the left because it makes it look terrible, but we created massive price inflation. And United Healthcare was a $30 billion company right before Obamacare passed. Today, it's a $330 billion company. And the level of growth that they and Aetna and, Cigna and Wellspring, these companies have seen is astounding. So these highly regulated, systems of societal infrastructure, that's where all the gains have been. Regulatory capture writ large.
Right. Well, as soon as the government is paying for it, all the suppliers know they can increase their prices. Why wouldn't they? So it's what happens is the government tries to make something free for people, and all they end up doing is making it really expensive.
They make it expensive in this very convoluted way, which is hard to track, right? Because it's who's actually paying? Well, the insurance companies want to just book more revenue, even if they're even if their gross aggregate profit grows much, much more slowly, they'd rather make the same amount of profit on $1 billion versus $100 million. So what do? Their incentive is to just jack prices up. Who are paying those prices? Companies pay those prices. Who bears those costs? All of this stuff is really not clear because ultimately downstream, somebody has to pay for this stuff.
If we look back, the last time we were at 6% unemployment, July 2014, we look at the unemployment graph, it spiked up to, as we discussed, 15%, and it has plummeted back down now to the 6% rate. If we look back on this moment in time and how quickly the economy is recovering from this disaster that we've never experienced before, it looks like this recession is going to be recovered and we're already back in business in such a short period of time compared to what happened in the Great Recession and the dot-com boom. So is America and the US dollar and the economy anti-fragile now, to use a Taleb term? How do we look at what happened with the economy? Did Trump do everything right with the stimulus?
This is a complete outlier in the following way. In a typical recession, what has to happen is, so you have a contraction in the economy, but you don't know when the bottom is, right? The bottom is some number of months in the future. And government policy is basically trying to create a soft landing where all of a sudden the cost of capital is low enough now where people say, on the margin now, this incremental dollar, I would rather borrow and invest, which drives growth, which then gets the economy going. And so, how does a government deal with that? They are looking at economic data and saying, okay, you know what? Let me cut rates. I'll cut rates again. I'll cut rates again. And that's really the one tool that they have in their toolbox because they're trying to predict in the future, how many rate cuts do I need to get or have rather? How big do they need to be until I get to that place where you bottom out? The pandemic was the exact opposite because in many ways, we actually hit the bottom in month one because we said everything go to zero right now, right? When you shut everything down, you technically can't have less economic activity than zero.
Yeah.
And so in many ways, you price the bottom on day one, boom. And in hindsight, the real insight would have been to see that and say, I'm buying this moment because it only gets better from here. So in one ways, like all of the tools are actually now we need to think about them in opposite. And I don't think we have that training to do that well.